Today, we're in a world of America first. We are in a world of China emerging as an alternative superpower. We're in a world where democracy is considered less preferred political system. So in any large language model, first you give context. What do you want to do? What are you looking at? And then you ask the question, right? Well, in real estate investment, it's exactly the same. First, you reduce your opportunity set. And then once your opportunity set has been reduced, then you can afford to be bottom. Well, this is not a competition. The big managers will remain big, and the small managers will remain, small and nimble. There might be some consolidation down the way. But what I'm saying is that the period of brutal polarization that we saw in the last 15 years will stabilize.
Jose, welcome to the People Property Place podcast.
Thank you. I'm glad to be here.
It's a real pleasure. Thank you so much for joining me. So before we get on to Evonite, the business that you set up last year, as well as your views, opinions and take on the market and where the opportunities lie, can you just tell me how and why you got into real estate in the first place?
I didn't choose real estate. Actually, real estate chose me. So I was working for Deutsche Bank. I wanted to be an applied economist back in my 20s. And I was working for the investment banking department, and I was doing some internal consultancy for the leverage finance team. So one day I would do a project for a company that produced mozzarella cheese. The next day I would work on a project for a company that produced tires. So it was very varied. It was very interesting, but I wanted to specialize in an industry. And then the dot-com bust happened, and there was a drainage, or there was a slowdown in projects like this, but there was an increase in real estate related projects. So at one point, the bank where I was working decided to move our whole team from generalist working for the leverage finance team to asset management and working for real estate. And that's how I became a real estate researcher.
So post 2001,
Exactly.
You were kind of almost put into the real estate space because there was more work there.
Because there was more work there, exactly.
You've worked with businesses such as Roxburgh, Goldman Sachs, AEW, Patrizia, and M&G that you touched on. What are some of your reflections and lessons over the years of working in a strategy seat?
Okay, reflection number one, people should listen to their strategists more. Yeah, when we talk, we don't, we're not just chatting for the sake of chatting. We generally, think about what we want to say, right?
You say that like you relate very personally.
I relate very personally to this, yeah. So obviously the more senior you get, the more you're listened to, right? But the more embedded your strategy team is in the general business, the better it is for the business. That's an important reflection for any investment manager, CEO that's listening to this. Your research and strategy team, you'll get far more value out of them if you embed them more in the general business.
Why?
Because we're very good at mapping what is going on in the macro political environment with the real estate environment, with the business environment. So number one, we're very good at that. Number two, we're very good at understanding a set of problems and packaging them into a set of actions. Now, that's the second thing. The third thing is, and that's rare in the property industry, we think in terms of time, right? Okay, so someone who works in real estate is very good in the three-dimensional world, right? So, we are property, three-dimensional, volume, right? But volume here and now. People with my background, we think volume, but we also think time, right? I think, okay, when did interest rates rise? When was the Euro crisis? When was the global financial crisis? Did we see this before? Have we seen this before? Let's go even back, to the beginning of the 20th century. Have we seen situations like today in other periods in history? We think in terms of time.
Whereas an investor will look at an opportunity pound per square foot, massing, expansion, return on investment.
And what would happen now? What happens now? So there is a tendency to think in the here and now, but there is less of a tendency to think what happened before.
In terms of your research, I'm assuming it's qualitative and quantitative.
Very good question. When I was young, it was very much quantitative. As I've grown older, it's become a lot more qualitative. And I think that real estate is not transparent enough, and it doesn't trade frequently enough to do serious quantitative analysis.
Really? There's not enough quantitative analysis out there?
There is, but I don't think it is as worthwhile as you would think. So let me give you an example. Forecasting real estate rents, real estate vacancy, real estate yields 5 years forward, I think it's a very difficult exercise. It's a very difficult exercise. I think that forecasts can, at the end of the day, they are, and I've been a forecaster in the past, so I know how these things work. I think that forecasting is an exercise where you have a prior on where you think things are going to go. So that's your prior hypothesis. And then at one point, things revert to the mean, right? So your forecast is your hypothesis and then a mean reversion, right? To me, that and nothing is pretty much the same.
So you touching on kind of herd mentality, gut feel, instinct, groupthink. Is that what you're alluding to?
No, but we can talk about that if you want. Okay, so let's talk about the industry today, and let's talk about the environment right now. So we're in a world in which when I talk to investors, and the vast majority of them tell me, I want to do bets, sheds, and alternatives. I believe in long-term tailwinds, digitalization, so I'm going to invest in data centers, demographics, so I'm going to invest in senior housing, e-commerce, so I'm going to invest in logistics, shortage of housing, so I'm going to invest in residential. So they are very simple cause and effect types of reasoning.
Yeah, you're talking about thematics, right? It's kind of supply and demand, or just...
No, but what I'm saying is the following, is it's very simple to say artificial intelligence needs data. So therefore, I'm going to need data centers. Let's invest in data centers. The population is getting older. We're going to need more nursing homes. So I'm going to invest in nursing homes. Offices are tainted because of decarbonization and because of hybrid working. So I'm not going to buy any more offices. So those are very simple reasonings that everybody's making. They're fairly obvious. And as a consequence, that reasoning is affecting reality. If you look at the transaction volume over the last 3 years, predominantly the sector that has been traded the most have been beds and sheds.
Yep.
Right? Have been beds and sheds. So it is affecting reality. It is affecting pricing. Okay? Now, what I think the reasoning people don't make is the following, is, okay, yes, there's going to be digitalization. Yes, there's going to be data centers. But what price am I paying? And what is the risk? Yeah? That's a reasoning that I don't see that many people, at the very least, talking about. Right? So let me give you an example of data centers. Data center is a new technology. It's very energy hungry. And everybody's thinking about AI and ChatGPT-5, which is a large language model that consumes a lot of data and a lot of energy. Every search you do is incredibly data heavy, right? Now, that requires a lot of data center power. But then you had DeepSeek coming in, which is smaller, doesn't require as much data. And for a day-to-day user like you and I, right, fulfills 90% of the functionality. And it doesn't have in its data set the most advanced quantum physics theories, right? Which ChatGPT has, okay? Now, how is AI going to develop over time? How much data is it going to need, right? What is the depreciation of a data center? Is data center construction technology going to evolve so that it's going to be less energy heavy? What is the depreciation? So all of those risks, and a 4% yield on a 10, 15-year lease to Google, right? Is that a good price? Is that inflation linked? What is Google? Who will have the bargaining power when the lease renews? It's not very clear, right? So a data center entails a number of risks that I don't think that people are necessarily taking into account. But what everybody's doing is, yes, data centers is the future. Yeah, but just remember those two questions: at what price? Yeah, and what are the risks? And let me give you a historic example. I mean, I'm using this in my talk tomorrow. So, in the 1840s, right, the first railway lines were inaugurated, right? So the first passenger rail line between two cities, Liverpool and Manchester, right, was inaugurated in 1830, okay? Then everyone realized, oh my God, this is going to change the world. There won't be any more horses. Canals are far less efficient than railways. Let's build railways, right? So in 1846, right, there were planning approvals for something like 270 new rail lines. Around 40% of Britain's GDP, right, was investing in rail lines, right? And the share price of all these new rail projects went through the roof. Guess what happened a year after? It collapsed. It collapsed because loads of new railways were not viable. The costs were much higher. People who had bought shares did it using debt. Okay, so that's called the railway mania, the railway bubble that took place in Britain in the mid 1840s. Okay, so but what were people thinking? What people were thinking was, okay, this is a new technology. It will revolutionize transport. And the world's going to be completely different. And it's so much more comfortable. It's so much faster than a horse. So this is the future, right? I want to be part of it. And of course, it was the future, but at what price? And did many of the projects make sense from a cost-benefit perspective? So what I'm saying to you is that in the world of data centers, there are many parallels between that and the railways in the 1840s.
Where do you see the opportunity right now from a kind of a macro and a micro perspective allocating capital into real estate?
Okay, so at the moment, I think I should give you a little bit of context before answering that question, right? Okay, so I think that the two things that because of this herd mentality that we're talking about. So you've got on the one hand the sectors that everybody wants to go to, and then the sectors that nobody wants to go to. Let's talk about offices for a second. So everybody thinks that offices are risky. Offices will require a lot of capex, decarbonization. Hybrid working is a thing. Loads of people have an over-allocation to offices. And therefore the narrative is, okay, let's buy prime offices, the top 5% in a city. And the rest, I'm not touching them. So you have a very, very big gap between the price per square meter or the yield at which you would buy a prime office today And the yield at which you would buy an office that instead of being top 5% is top 15%. So in the world of value add, contrary to what many people say, so many people say that value add is about buy, fix, sell, okay? I think that value add is about identifying the risks that are cheap and acting on them. And that's a very good example. There is the risk of depreciation and liquidity of your top 15% offices. So the offices that are not top 5%, but are within the top 15%, top 20%. So the risks attached to that layer of the office sector are incredibly cheap. Or in more mundane terms, the gap between prime and slightly less prime in terms of yield is very high.
At this moment in time.
At this moment in time. But that's the core. Sorry, the core is, that's a bad expression. That is the key to value add investment. Identify where the risk is cheap and acting on it. Let me give you another example. In 2012, between 2010 and 2012, there was no development of offices or any sector for that matter. Everybody was afraid. Many construction companies and developer companies had no work. So the development yield relative to the investment yield, the gap was enormous. So development risk was cheap at the time. Whoever made development at the time, right? So Land Securities and British Land built the cheese grater and the walkie-talkie respectively at that time, right? That was a very clever move into a risk that at the time was cheap. That is the core, again, I've said core, that is the essence of value add investment. Identify where risk is cheap. If you have that mentality, that's where your performance should come through in the value add world.
10, 15 years ago, there were a lot of pan-UK, European, multi-sector discretionary fund management businesses who would be able to move in and out of sectors relative on risk and reward. Mm-hmm. In the last 7 or 8 years or so, there's been a shift towards more thematic investors, logistics, living, and other platform builders who've been able to raise and deploy a substantial amount of capital into their market. And they've almost become in vogue in the sense over kind of more generalist real estate private equity investment management vehicles. Mm-hmm. Where do you sense and see the opportunity? Do you think it's a reversion almost to that generalist who manages real estate and sees commercial real estate as an asset allocation rather than a stock pick?
Ooh, okay. There's a lot in that question. Okay, let me start by thematics. As a strategist by background, I'm generally a believer in thematics, okay? The thing is that from a fundraising point of view, the thematic that you're selling has to be easy to understand. So when I say, yeah, there's a trend of digitalization, there's a rise in AI, so I need to build data centers. That is a very easy to understand thematic, okay? There's not enough residential. Rents are increasing by 15% a year. So I need to invest in residential. That's a very easy to understand thematic. Now, I am a believer in thematics structurally because of my background. But I think that those easy to understand thematics have run their course. Now.
And is this what you mean about a new world?
Oh, okay.
That's for later. Sorry.
That's for later. No, we can talk about that. But the point I'm making is I do believe in thematics, but my thematics today are about where risk is cheap. That is the concept I always work on. Okay. And the high level thematics that I've just described to you, I think they've run its course because everybody's doing them. So a thematic works when not many people are doing it. when it's new, when it's fresh. That's the kind of theme that will bring you performance. But when you follow a thematic that Blackstone or somebody else is following, then you're already a price taker. Then it's not necessarily going to bring you performance. Now, a second part of your question was, do I therefore believe that you should have a scattergun approach to real estate investment, do it deal by deal, do bottom up only, right? I don't believe that's the case either. You can only do bottom up only if you are very specialized. Yeah?
And specialized in what sense?
What do I mean? Imagine that you are only long income. Yeah? You basically say, I only buy 25-year leases. I don't care whether they are in the North Pole, but therefore my job is to analyze credit.
Whether that's roadside, retail, logistics, office, whatever it is,
my fund is only 25-year plus leases. So that's a credit deal. That's not a real estate deal anymore. So my job is to analyze the credit quality of the occupier, right? So I'm just bottom up. It's analyzing that occupier, right? So then you can be bottom up only, right? But if you are in the world of, multi-sector, multi-country, value add, or even core, you cannot afford to do that.
Because?
You cannot afford to do that because you don't have the focus. Yeah? Because you basically are a slave. That's not an English expression, but that's the way we would say it in Spanish. You're a slave of the deals that come to you.
Yeah, because
you
there's
seek the deals.
Yeah, because there's if you appeal to everyone and everything, you appeal to no one, right?
Exactly. You just receive the deals that your brokers are sending to you, and then you pick and choose, right? But then, if you're in thematics, then you say, okay, I want logistics, and I want logistics next to big cities. Then, okay, you've now reduced the market quite a bit. Right? Let me give you a very silly example with this. If you do a search, if you work on ChatGPT or you work in any large language model, I don't want to make publicity for OpenAI here. So in any large language model, the first thing you've got to do to prompt effectively is to give the model context, so that the model is already narrowing down, the potential searches within its database. And then it's far more effective, the answer you will get, right? First, you give context. What do you want to do? What are you looking at? And then you ask the question, right? Well, in real estate investment, it's exactly the same. First, you reduce your opportunity set. And then once your opportunity set has been reduced, then you can afford to be bottom up.
So that's the middle ground, and that's how you blend top down and bottom down.
Yeah, exactly. You start, so top down is to narrow down the opportunity set. Then within that opportunity set, you can afford to be bottom up.
And then you can pivot across the sectors where the opportunity is, or where the risk at that relevant time presents the reduced downside but maximum upside.
Yeah, let's call it that. Let's say that, at every value add vintage, you will say, okay, these are the three themes where I think there is an opportunity today. Okay, that's my reduction in opportunity set here, right? And I work on those three themes. If you are sufficiently nimble, and in the value add world we have to be, right? Then, 12 months have passed, 9 months have passed, and then you realize, okay, this opportunity has run its course, but this opportunity has arisen. I'm pivoting my themes a little bit.
You talk about being in a new world.
Yes.
You talk about that quite a lot. And you're very active on LinkedIn. So I will say to the listeners, if they don't follow you, go and follow Jose on LinkedIn. He publishes very regularly and very insightfully and very thoughtfully. Talk to me about your concept or your views on this new world and new world order.
I started university in 1992. And in 1992, just to give you one context, communism had just died. Okay. It was the beginning of the triumph of globalization, of free market capitalism, of free trade agreements. There was only one power in the world that ensured that the seas were safe to trade. It was also the emergence of China in the world as a world powerhouse. World powerhouse. Let's call it world factory. Okay, so that's the world where we've all grown up in, right? A very predictable world where there is just one superpower. We know that there are no pirates in the sea because the superpower makes sure that there are no pirates. That there are no wars between countries because the superpower ensures that countries, at least in the developed world, don't go to war with each other. And most conflicts effectively in the last few years have been within countries, not amongst countries, right? Now we're in a different, and you have international organizations that somehow police this, and several countries could police the situation. Now fast forward to today. Today we're in a world of America first. We are in a world of China emerging as an alternative superpower, followed by a number of countries. We're in a world where democracy is considered less, like the liberal democracy is less the preferred political system. And as you can see, even in democratic countries, semi-autocracies are arising, where the incumbent is actually taking more and more power.
The rise of the right.
The rise of the right. Also the rise on the left, in other
polarized.
countries, right? Yeah. But the reality is that it is a far more complex world. It's a world also where there is far less globalization, far less trade within countries, where there is beginning to be some questioning about the dollar as the global currency. I'm not saying that anytime soon it will stop being, but you can see that China is beginning to battle for an alternative. So it's a much more complex world. It's a world that is not the same what we have grown up in. Okay, there's more hostility to immigration, and trade is far less safe, which basically means that supply chains are going to be more expensive, that less people are going to come to Britain, which basically means that labor costs will become higher. And therefore, there are very serious risks of more persistent inflation down the line. Just look how difficult it has been for inflation to go back to 2%. And in Britain, we're at 3.5% still, right? In other countries, it's gone down more. But you can see the hostility to immigration and the slowdown in trading operating. So my point is that this is a new world that requires new investment, a new world from a geopolitical perspective, and a new world from an economic perspective. And if you go back, allow me to basically talk about my historical analogies. So my sort of untested theory is that in the last 150 years, there have been periods of stability and periods of turmoil. My whole professional career has happened in a period of stability. The 70s and early 80s and late 60s were a period of turmoil. People were assassinated. There were loads of internal terrorist groups. So presidents were assassinated. Martin Luther King was assassinated, right? Robert Kennedy was assassinated, right? You had the rise of, Malcolm X. There was a lot more social turmoil and a lot more economic turmoil. Then you had the great inflation. You had the big deindustrialization, which, as you know, in Britain was a big deal, right? There was a period of turmoil that was followed by a period of stability. Right? Now we are beginning a new period of turmoil. In a period of turmoil, you've got to be very careful where you invest into, right? And you have to be very, very cognizant on investing in things where you can pass on that potential inflation to your occupants.
Property is a people business, hence the name people property place. Business has been tough the last couple of years. Get the people aspect wrong, business becomes impossible. Get the people aspect right, it's still hard, but it's manageable, much more enjoyable, and you're much more likely to hit your goals. So if you're looking to add top talent to your team in 2025 and you're open-minded to an alternative approach and you're keen to make business a little less hard, drop me a DM. I'd love to have a conversation with you to see how Rockborn could potentially help you with your human capital requirements. Right, let's get back to the podcast. So my first question is, what is the implication for investors in Europe? And the second question is, what is the implication for real estate?
Okay. So investors in Europe means that in a period of stability, you can talk about long-term tailwinds because the general geopolitical and economic context you assume is stable. But in a period of turmoil, it's much more difficult to talk about long-term tailwinds because the turmoil is such that they can affect that very smooth, more technology means more data centers, or aging of the populations means more senior housing, or lack of housing means that, I need to invest in residential, right? So things can happen. Affordability can be a problem in residential. There could be regulation. So governments might decide, okay, in senior housing now we're going to have rent control. You cannot increase rents anymore. Yes, there is inflation every year of 5% or 7% or 3%, but senior housing, no, we're going to freeze rents by decree, right? You can have rebellion of young men without jobs that cannot find housing and therefore, have, riots on the street in the same way as happened during the deindustrialization period in places like Liverpool or Sheffield or wherever, right? All of these things can happen. So you cannot plan in terms of, as smoothly as you would have
previously.
Exactly.
Certainty. And I guess real estate investors, business owners crave certainty. And what you're saying is there isn't the certainty, there's volatility. And that probably leads us on in terms of what are the implications and what does that mean for real estate investors? Because the conversations that I'm having, people are saying, that certainty in that period of transparency has ended. And now, every other month, there's something else we have to deal with, whether it's Ukraine war, inflation, tariffs, you name it. Now that is the new world order. And we have to generate alpha through a period of uncertainty. And we have to get quite granular in terms of how we drive those returns.
Exactly. And therefore, what is the problem here? There is an additional problem, which has less to do with the global order, which is the following, is that in the last 15 years, we had a period in which your property yields had a very comfortable spread over your financing costs, right? So returns were about levered income and yield compression. Fantastic, right? My old boss used to say, so if you were a trained monkey, you would have performed, right? Because it wasn't that hard to perform during that period. Now we're in a world in which your financing costs are higher, and yes, your property yields are higher than your financing costs, but not everywhere, right? But if you want to generate your risk premium that real estate should have over fixed income, right, you have to rely on rental growth, okay? So in a period of turmoil or volatility, where can you achieve rental growth, okay? And that's not as simple as it sounds. It's partially a supply-demand thing. Of course it is, right? It's partially a supply-demand thing. But it's got to be on types of properties that give you a margin of safety. What do I mean by a margin of safety? What I mean is, if you are buying apartments at a 3.5% yield, net yield, and you expect your rent to go up by 10% per annum over the next 7 years.
That's in your assumptions.
And affect 10%, 5%, it doesn't matter. But what I'm trying to say is, and assume that there's not going to be an affordability problem, right? then I think, I would think twice. You have to rely on rental growth when you are sure that your tenant base is sufficiently financially sound to be able to afford that rental growth.
And
That's number one.
And you're looking for your total return to come from capital appreciation rather
Your
than
total
income?
return needs to come. So I was having coffee with someone today, and we were talking about the following. So returns in real estate are about yield plus rental growth. In the last 15 years, they've been about yield plus leverage plus yield compression. That's gone. Now it's yield, maybe leverage if you're lucky, and rental growth. So you need to think about that rental growth, right? And that rental growth has a number of inputs. One is supply and demand, but the other one is affordability, which affects demand big time. The other one is so it's affordability. The other one is the sector tried and tested? Yeah. You have a sector that's not tried and tested, then it's a bit of a problem. Let me give you another example. That's a brilliant example. Everybody is now obsessed with hospitality, hotels. Why is everyone obsessed with hotels? Because they are an alternative asset and they have beds. Okay, I can tick my beds box and I can tick my alternatives box.
And I get to change the rent every single day.
And I get to change the rent every single day if it's an operating contract. Now, not just that. So from all the alternative sectors, hotels is the biggest. So I've got a bit more liquidity. So a number of investors are buying hospitality as caravan parks, for example. Right? They're buying caravan parks. That's a hotel, right? That's hospitality. So here's my take of this. My take is there hasn't been any fundamental change, right? The point that you're making about experiences, that was true in the millennial generation, people born in the 80s, right? I mean, and they're already in the 40s and they're having children, right? So nothing, the post-COVID boom started in 2022 and now it's sort of, tailed off, right? So you are in a situation today in the hospitality sector where nothing has changed. People are still going on holidays. People are still traveling, but the same as the last 10 years and the same as the previous 10 years. Nothing has fundamentally changed. What has changed...
Well, there's a cost of living and maybe people aren't going on the types of holidays that they did previously and they don't have the budget or the discretionary income to spend on those types of holidays.
Well, that's fair enough, but that only affects the type of hotels they would go to. But they would still go to hotels, so they would go to other hospitality outlets, right? Hospitality would still be used. Maybe it's the quality or the price point at which we're talking about. But I don't think anything has changed. What has changed is that now hotels are seen as an alternative asset with beds. Now, the point I'm trying to make here is that because nothing has changed, the yields have come in. So it's more expensive to buy a hotel now. Mainstream investors are going more niche in the hospitality sector. That's caravan parks, right? But of course, at the price that they're buying, they still need rental growth. And they're expecting to get rental growth from hotels in a sector where nothing has particularly changed, right? Now, that is the problem, right? The problem is that hotels are seen as attractive when nothing has particularly changed. It's only narrative that is happening. Yeah? It's nothing fundamental. So where you have to seek rental growth in the current world is in sectors where there is a supply-demand mismatch. There is no supply-demand mismatch in hotels.
So are managers who've got deployment pressure from their LPs driving this? Or what's driving this allocation? Is it getting money out of the door, otherwise they lose it?
It's this narrative that I need to invest in beds, in sheds, and in alternatives because offices are seen as taboo and retail, whilst this starting again a little bit, is it's not what it used to be. So therefore, people are trying to expand the opportunity set, and they're using hospitality as a way of expanding that opportunity set.
There's been lots of talk in the press, not just within real estate, but other kind of private equity or investment management vehicles of continuation funds.
Let's talk about that.
What's your take on continuation funds? And for those who are listening who maybe haven't come across that expression before, can you just set the context in terms of what that is and where it fits in?
So a continuation fund is basically a closed-ended fund that in a particular vintage, that it's buying some of its assets from a previous fund vintage from the same manager.
Yeah, from the same manager.
Yeah.
Correct. So it gives them an exit.
And gives them an exit. So in a way, it's an outlet for a fund that needs to close to be able to sell the assets that it has bought because it hasn't found sufficient liquidity in the market, right?
So it's a way of exiting it, crystallizing return, but keeping the management and keeping the fees.
I mean, that would be the cynical interpretation, which, as it happens, is the interpretation I share. But yeah, that would be the cynical interpretation. I mean, the more generous interpretation is that, well, we own this asset, we haven't quite finished the business plan, this fund is closing, so why don't we transfer it to the next fund in order to be able to extract the maximum amount of value from this asset? That would be the way a manager would sell it to its investors. The cynical interpretation is, okay, I got an exit, potentially I'm crystallizing a promote, potentially, okay, and then I get to keep the management, and I don't incur losses, so I get a little bit of performance here. Right, so that would be my cynical interpretation. So from my way of speaking, you would have concluded that I generally believe that the continuation fund is no more than an excuse that managers are giving themselves for not having done their job properly. What do I mean by this? What I mean is, when you buy assets, you assume you basically match your return and your risk. And liquidity risk in our industry is the biggest risk.
Due to the uncertainty that you touched on earlier.
It's the biggest risk always and in general. Okay, so selling the asset for the price I've underwritten is the biggest risk always in real estate.
Regardless of conditions.
Regardless of conditions. That's the risk ex ante. When you buy an asset and you're going to sell 5 years from now, you don't know the conditions 5 years from now. So the biggest risk you're taking is liquidity, generally speaking. Okay? So 5 years from now come and you have no liquidity. Okay? Well, you have a problem, right? So it's human nature to say, okay, how can I maintain this asset under management? How can I maintain my fees? How can I not underperform big time? Through a continuation fund, right? It's a way of hiding my own skeletons in the closet, putting more skeletons in the closet. That would be the ultra cynical interpretation.
There's been a big structural change in terms of real estate managers as well. A lot of the big funds are getting much bigger. There's lots of smaller, more entrepreneurial platforms that are set up. Evonite is obviously kind of one of them. And there's a squeezed middle of 2 to 10 billion that are that some commentators are saying are struggling for relevance. What's your take when you take a step back and you look at the competitive landscape from a fund management perspective?
Yeah, so that's a very good question. The fund management has become incredibly polarized, right? Regulation is clearly a factor. So every fund manager has to incur a number of big costs to be able to cope with regulation. Therefore, those costs are sunk. So it's very difficult to be an entrepreneurial organization like we are. So you need to be of a certain critical mass to be able to withstand those costs. That's number one. Number two, investors are themselves generally under-resourced, and therefore, and every new investment and the underwriting of a new manager requires a lot of work and requires a big internal bureaucratic process if you're a pension fund. So it is safer, easier to go to the same mold.
Yeah, you're not going to get fired for it, right?
You're not going to get fired for it, right? It's much easier. It's much less time consuming because, you just piggyback on somebody else's due diligence, right? So that's partially the reason why the industry has become more polarized. There is another one, right? And I'm known for, being very Blackstone unfriendly, but let's be honest about Blackstone, right? They've performed for 15 years, right? The first funds actually got it just right. They went into logistics at the right time. They went into prime offices at the right time, and they exited at the right time, and they banked an amazing performance, right? So, they also have an amazing fundraising machine, and they have very capable individuals at the top. However, because they're so big, because they're so influential, right, the industry has the risk of what I call the bad emperor problem. What do I mean by the bad emperor problem? Let me give you a historical analogy, right? If you are the Roman Empire, the big cheese in the Western world in the ancient period, right? If you are led by a guy like Marcus Aurelius or like Trajan, happy days, right? But then if Marcus Aurelius dies and his son takes over Commodus, who was a complete, what word is...
Egypt? Egypt?
Egypt. Okay, I don't know what that means. But anyway, let's assume that that word describes
someone who's inept, maybe.
Yeah, exactly. The lack of capability, massive ego, and stupidity of that individual. Then, you basically set up the whole empire for its collapse, right? So that's the bad emperor problem. When you get an industry that is so utterly dominated by a single organization, where the strategy is made by a small clique of individuals or one single individual, whatever it is, in a single city, right? Then there is that risk of getting the bad emperor problem. Then if every investor finds it easier to invest with that big manager, and then you get a bad emperor or a bad decision, right? Then that's when problems arise.
Yes, Sam Zell has got that famous quote of saying, when everyone goes left, go right.
Exactly. Very similar, right? Unfortunately, he's no longer with us, as you know. But yeah, I've been saying, Warren Buffett says, when the tide turns, you'll see who's swimming naked.
So based on what you've just said then, what's the opportunity for the new manager now?
Okay, so that's a very good point. So I talked about Blackstone earlier, right? And I said, okay, they're very big, they're very influential, etc. But they're so big that in order to reduce the opportunity set, as I said earlier, they need to do these big conviction plays, right? And they've been very public about it, right? So I'm not paraphrasing, right? They've been very public about it. But we are in a new world. We're in a new world that changes a lot, that is not as stable as the previous few years, including the global financial crisis, right? Yes, there was a big crisis, but that was within the framework of the world I described earlier. But going back to your question, what a new manager brings is being nimble, observing the world and being able to pivot. I've worked for a big business before. And in a big business, changing an allocation, increasing allocation to X, decreasing allocation to Y, it's all moves like a super tanker. Doing a pivot takes time, approvals, bureaucracy, committees, etc. Right? If you are a new manager, it just requires a meeting between the 5 partners with some checks. Within a week, we've pivoted if required. Okay, so we are nimble and we can make decisions. That's number one. Number two, you can get the senior team to look and interrogate a deal in a lot more detail than if you're a big manager. So at M&G, I had no time to, a deal would come to me at investment committee level, right? I would read the report and I would say, okay, these are the risks. How you cover for the risks? And there was a lot of inherent trust that I had to give both my fund managers and my transactions teams. If you are a new manager, the partners, all of which have 25 years experience, right? We can interrogate the deal and the risks in a lot more detail. We can scrutinize what we do, right? A lot more. Thirdly, a new manager that is nimble, that can scrutinize things very well, it's important to have the experience, right? So we have lived through the global financial crisis, right? As I said, the global financial crisis wasn't a paradigm shift, but it was a big change. And we all learned big lessons from the global financial crisis. So the vast majority of people who work in our industry today haven't experienced the global financial crisis. If you started working in 2010, 2011, right? This means that you were like, let's say you were 22 in 2011, right? So, you are now what? 30, what am I saying? 36, right? So you're relatively senior, you execute, but you don't remember how an investment can go horrendously wrong.
Yeah,
right?
yeah.
It's true.
Yeah.
So having that experience also helps. So nimble experience, scrutinizing deals, right? That is what a new manager can bring to the table that the big tanker does not.
You've missed
Fourth
one
thing.
Okay.
Oh, yeah. Well,
I was going to say you don't have any legacy issues. Is that your fourth thing? I thought you were stopping at 3.
That was my fifth. But
that was your fifth. Okay.
Yeah.
Fourth thing.
No. Fourth thing. If you know and if you believe that we're in a period of turmoil, right, you have the flexibility to say deep conviction does not work, right? And I think it's very important that your listeners realize that deep conviction requires a period of stability, right? Deep conviction, your thematics need to take into account that things can change a lot and there's a lot that we cannot predict, okay? And then fifth, no legacy. So you're not a forced seller and you're not a forced buyer, okay? So you just think in terms of performance. There's a sixth one, what I call brutal alignment, okay? So if we don't perform, we won't be in business. Yeah. So an investor that invests with us or any other small manager knows that the manager has to perform for them. They will do the utmost for them. They will spend sleepless nights for the investor, because if performance is not there, the business is dead. And many big managers don't have that pressure that a small manager has.
So over the next 5 to 10 years, who wins?
Well, this is not a competition. The big managers will remain big, and the small managers will remain, small and nimble. There might be some consolidation down the way. But what I'm saying is that the period of brutal polarization that we saw in the last 15 years will stabilize. I don't think we will see more polarization in the same way as we had, right? In every industry, you have big players and small players. Yeah, there's some industries in which you can only have a handful of small players, but those are industries where the barriers to entry are high. The barriers to entry in our industry are not high, are manageable, right? I mean, why could like a bunch of 5 blokes and a lady, create a business from scratch, right? Because, without, yes, there are barriers to entry, but they're not enormous, right? We could do it, right? And we don't have a massive capital backer, giving us tons of money to do this, right? So there will always be bigger and smaller, but I think that the brutal polarization will slow down.
What's the biggest misconception about value-add real estate investing today?
So the vast majority of people in the real estate world think that value add is about buy, fix, and sell.
Yep.
And when when you hear this, the idea you have in mind is, okay, I buy a property, I invest capital into the property, make it nicer, and then sell it. Okay. I call that being in the business of creating beautiful properties. That's not being in the business of making performance from properties. Okay. So value add is, as I said earlier, is predominantly about identifying where risk is cheap. So this is the first and foremost value add skill in value add investing. Okay. So, for example, buying in Spain in 2013 at the height of the Euro crisis, Spain had the risk was cheap, right? Doing development or doing heavy capex in that period, capex risk was cheap at the time. However, fast forward to 2018, 2019, even 2022, right? If you were doing a value add fund and you were saying it's going to be entirely about development, I would say you're bunkers. So development wasn't cheap. Construction costs were high. The gap between the development yield and the investment yield was low. That's the business of creating beautiful properties. It's very nice in the brochure, right? But it doesn't make investors money.
Yeah. So that's the biggest misconception.
To me, that is the biggest misconception that many people in this industry have about value-add investing.
So they're busy fools, running around making buildings beautiful, but not actually driving alpha.
Well, I wouldn't insult anyone in our industry, but I would say that, yes, from a visual point of view, from an aesthetic point of view, is fantastic.
We've talked about the world. We've talked about some of the changes. We've talked about the changes in terms of managers, allocation to real estate. Talk to me about the European opportunity.
Okay, yeah, that's a very good question, because we talked about the general world, but we haven't really talked about Europe, and our field of operation is Europe, right? So where is Europe today? The general conception about Europe is that we are the squeezed middle. We're not China and we're not the US. We're rich, but we spend all of our money in social programs, right? So, what are we doing, right? Well, I think that Europe is not the squeezed middle. Europe is actually a land of opportunity right now that people don't see. And I'm going to tell you why. Number one, yes, we are squeezed middle, but we are the rich guys in the middle, and we're not the fat cats, because we can work with China and we can work with the US, right? We're not. So we can trade with China, and if the US tell us don't trade, put up 100% tariffs on Chinese goods, we can say maybe yes, maybe not, right? So we are discovering our own bargaining power from a geopolitical perspective. That's number one. Number two, we're investing in defense now. So between now and the next 5 years, we will be armed to the teeth. We will create a new industry, right? That will mean economic growth, new jobs, new technology, right? So all of that will create value add to the general economy, okay? So that's generally pretty good. And then thirdly, there is a point in which we will say we need to get our act together. Okay. Now, I'm talking geopolitically here. Let's talk real estate. Let's talk real estate investing. I said earlier that offices are seen as doomed, right? So offices in Europe are a very interesting hunting ground. Why are they an interesting hunting ground? Because there is a mispricing between the top 5% and the rest, right? Just compare, the West End of London with central Manchester. Very, very big difference in terms of yield gap. Let's talk an office that was built in the last 5 years versus an office that was built in the last 15. Okay? So long as you interrogate and understand the decarbonization strategy and the cost, and that's in the price, then, that's an opportunity. Thirdly, part of the logistics sector close to defense hubs is also going to be an opportunity, because that's the growth industry now, right? So a strategy that is around defense and defense hubs should be a winning strategy over the next few years, right? And then the next thing about Europe is that in a number of places, it's repriced already. So there's a pricing advantage. The office market's functioning much better than in the US, right? And retail is coming back at very interesting prices. So from a real estate perspective, just think contrarian, office and retail. Everybody's going to everything else. Office and retail are interesting. You've got a lot in the price to play with. That's number one. Number two, defense hubs, right? Defense is going to be the growth industry now, aerospace, defense, drones, etc. Just think defense hubs. And then number three, Europe hasn't yet gotten their act together about the bargaining power. It's beginning. And I think it's going to happen over the next 5 years, playing one big guy against the other. I think that's coming. So I think that Europe is a very good land of opportunity today. And I think that slowly, as people see a lot more uncertainty in the United States and more unpredictability in the kind of decisions that will take place in the United States, we'll see Europe as a place of stability and predictability that the people wouldn't have considered before.
So say I am a global LP and I'm looking to allocate capital to you and I've got £500 billion. How would you allocate that?
Oh, I would do it completely contrarian, right? And I would have like a strategy that is around the mispricing of offices. I would have a strategy that is about the retail that is where you can pass on inflation to occupiers. And then I will have another one that's on defense hubs. So maybe industrial and defense hubs, maybe slightly bordering into slight infrastructure if you want. But those three, to me, are the key winning strategies in Europe.
And in terms of locations?
Well, that's the good thing, that now you don't really have the polarization that you had during the Euro crisis, right? So the UK is quite interesting in the sense that, you get much higher cap rates in certain sectors, but of course financing costs are higher, so you need to look at your leverage very well. There are certain cities that are defense hubs. So, Dusseldorf is one, but, Madrid is another, right? So you have very different defense hubs in throughout Europe right now. And then finally, in terms of retail, that depends a little bit on the yield, right? And on the availability of properties. But the important point about retail is the decarbonization strategy needs to be easy and simple. And once it becomes complicated, then that pricing advantage that you gets squeezed very, very quickly. So I'd say, yes, retail's good, but watch out for the decarbonization and make sure that the retail is sufficiently relevant to be able to pass on inflation to your occupiers.
So we've spoken about the property, the place, and in terms of the people looking to deploy that capital?
Come to Evonite. We're more than happy to talk to you guys.
I guess you've worked with a number of people over the years. Is there anyone who's not in Evonite that you would bring on the journey to help deploy that capital?
Well, there are loads of people that I value in this industry. But I think, without giving names, I think that the most important thing is culturally, they need to be unashamedly about performance. But number two, they need to be philosophically flexible. What do I mean by this? They need to be able to understand that value add is not about buy, fix, and sell. They need to understand risk. Our investment philosophy is about understanding risk and interrogating risk as much as we interrogate return, right? The person that comes with us needs to buy into that philosophy. If you don't buy into that philosophy, don't come to Evonite. But if you do, have a chat.
Sounds like real estate 101, but somewhere along the way, people have forgotten the very essence of risk management.
Risk and return, right? That's the first thing you learn in finance class, right? In finance school. Well, remember it.
Jose, you've had a fascinating career. I've loved diving into and exploring various different topics, from globalization to capital to the relevance of real estate investment manager, the changing nature and size and scope and USPs of various different firms, as well as your take on the wider market. So thank you so much for joining me today, and I'm really excited to see what you and the team at Evonite go on to do.
Pleasure. Thank you so much.
Hey, quick one from me. If you enjoyed this conversation, do me a favor and share it with a friend or colleague that you think would get value from this conversation. It would mean the world and help grow the People Property Place podcast. Thank you so much.